The US government is facing a much larger financial problem than most people realize. And so far, what we've seen from the Trump administration and the Doge team amounts to removing a few thimbles full of water from an Olympic-sized swimming pool. The thing is, it's not impossible to fix the financial situation the government is in. It's just a lot harder and more painful than most admit. In fact, there are only 4 ways out of the situation the government is in right now: printing, austerity, default, and productivity. While we won't see any of these solutions implemented in isolation, we are very likely to see a mixture of these solutions work themselves out over the coming years and even decades. And on a personal note, if you are facing a financial crisis of your own, all of these solutions are applicable to a personal financial situation as well. So let's take a look at each of these in detail and see how they might work themselves out and how likely we are to get solutions in each of these buckets. The first solution is printing our way out. In other words, inflation. Right now, the US debt to GDP ratio is around 120%, which many economists view as the point of no return. We were here before at the end of World War II, but we were able to quickly deleverage from there, at least the US government was, as a result of lowering spending from ending the war and a big boost in productivity from women entering the workforce and men returning home from war returning to the workforce as well. But one of the main tools the government used during that time in order to deleverage was inflation, and they did this through yield curve control. Many people are not aware, but the Federal Reserve introduced yield curve control in the United States, and it ran from around 1942 through 1951. This allowed the US government to borrow at an interest rate that was pegged there by the Federal Reserve. Now, the only reason why you'd have to have a central bank peg an interest rate is because without that, the interest rate would be much, much higher. This allowed the federal government to borrow money at a rate much lower than what they would have without the yield curve control. Because of this, they were able to borrow dollars at a rate lower than the rate of inflation. In other words, in terms of purchasing power, they were essentially getting paid in order to borrow. The cost of servicing their debt was negative. This allowed them to unload the cost of their debt onto the economy. But yield curve control during the 40s and the 50s, it's not the only example that we have of our government using inflation in order to offload the cost of its debt onto the economy. Now, as you can see from this chart of the Federal Reserve's balance sheet, they have been decreasing the size of their balance sheet in a process called quantitative tightening. In other words, recently, they've been doing the opposite of QE, which has been removing money from the financial system. This, among other things, has caused the interest rate on the national debt to increase wildly over the last couple of years. And the Fed also understands that if they pivot too early, too fast, and too much, they might reignite inflation. But they aren't the only ones who can do QE. And in fact, deregulation of the banks may be the next step to do stealth QE just through the banks instead of the Fed. Right now, banks have a limit on how many treasuries they are able to buy, which makes sense because even treasuries carry risk. If you buy treasuries and then they decrease in value, and then all of your depositors want their money back, you can't give it to them, because if you were to sell all your treasuries, you still wouldn't have enough to meet all the withdrawal requests. So even treasuries have risk, at least in the short term. But that has all changed over the last couple of years with some tweaks in the system and how the Federal Reserve backs up banks with their treasuries. Essentially, treasuries are now almost equal to reserves in that banks have the ability to temporarily offload their treasuries to the Fed at full price. And because this gets rid of basically all of the risk, even short term with treasuries, it stands to reason that the Trump administration may deregulate the banks on how many treasuries they are able to own, which means banks could print as much money as they want, loan money into existence to buy as many treasuries as they want, essentially doing QE for the Fed. Now, obviously, with inflation, whether it's through yield curve control, quantitative easing, or bank deregulation, it is the saver and the earner that pays the price. Because prices of assets and goods and services and the size of the economy, at least measured in dollars, will increase. But the wage earner doesn't get a cost of living increase on their paychecks until well after all the cost increases have happened. So they fall farther behind in their ability to save up to purchase assets and also their ability to just maintain their cost of living. And because the pain of inflation has been so severe over the last couple of years, the current administration seems to be very wary of taking any actions that would lead us down this road. Which brings us to option number 2, which is austerity. Austerity is just a fancy word for saying we're not going to spend more than we make. Hey, and real quick, just in case you missed it, this last Thursday, I hosted a free masterclass live on Zoom. On the call, I detailed something I call the asymmetric trade. This is a strategy that can help you profit from chaotic events months, and it's a strategy I have personally used to take home returns as high as 279%, 733%, and even 1,299% in a matter of months. And even though 1,000% plus gains are generally the exception and are not the rule, with everything that's going on right now, from the trade wars to the volatility in crypto and stock markets, to even the potential for World War III, I believe these trades will be the key to both growing and protecting your wealth in 2025. If that sounds like something you're interested in learning about, make sure you check out the replay. It's linked in the description below. From a personal financial situation, that's great. For the government, for some reason, most people think that's a terrible idea. And there certainly is some pain associated with it. This is a chart of the US government's surplus or deficit going back to 1981. And you can see that over the last couple of decades, it is eroding very quickly. And in 2024, the US government ran an over a $2 trillion deficit. In other words, even though the government took almost $5 trillion in taxes, the government spent about $7 trillion. And so they had to borrow the difference. Implementing austerity simply means that they are no longer going to run a deficit, or at least they're going to try and shrink that gap, meaning they only spend what they bring in from taxes. Or in an extreme case, like in 98, 99, 2000, and 2001, the government actually runs a surplus, which means in those years, the national debt actually goes down because the US government taxes more than they spend. Now, there are a few consequences to the government balancing the budget or even running a surplus. Consequence number one is actually that prices would start to fall. And while that is good over the long term, and we have had plenty of decades, even centuries throughout history, where prices on average just go down and down and down, that can be very painful in the short term if you have a big pile of debt that has to get unwound. Right now, the total money supply in the United States is around $21 trillion. However, the national debt is over $36 trillion. And that's just the debt that the United States government owns. That does not count all the debt that individual households owe and all of the debt that corporations owe. In other words, the amount of debt that exists in the system far exceeds the number of dollars that are in the system. This is because of the way that our financial system works and what dollars actually are. Dollars themselves are just IOUs and debt. When you deposit a dollar in your bank account, it gets loaned out to somebody else and shows up as a deposit in somebody else's bank account. And that process basically just goes on forever, which means everybody who looks at their bank account and sees dollars in their bank account, it's not actually really there. If everybody tried to go get their dollars, you'd have a bank run, that money wouldn't be there. This system works fine as long as you have a constantly increasing supply of money. Prices continue to rise, people continue to borrow and roll over their debt, and all along the way, all of that interest is getting paid for via new money that's coming into circulation. The problem is if the biggest borrower, in this case the US government, starts to run a surplus, that slows down or maybe even stops the increase in the supply of money. But all the debt still exists, and those dollars have to come from somewhere. And because all dollars have been loaned into existence, as that debt starts to get paid off, dollars cease to exist. And as the money supply goes down, the cost of assets and goods and services also have to adjust down to the lower quantity of money. This is the opposite of inflation. This is deflation. Instead of more money chasing the same amount of goods and services, you have less money chasing the same amount of goods and services. And when this happens extremely quickly, you get a debt death spiral or a deflationary death spiral, like happened in the first Great Depression or in the Great Depression after 1929. And the main people who pay the price here are the borrowers, because as you borrow in an inflationary system, you get to pay back that debt with dollars that are worth less than the dollars you borrow. Those dollars are worth less because there's so many more of them compared to the supply of goods and services. But in a deflationary death spiral, you get the opposite. It gets much, much, much harder to get your hands on money because money becomes more scarce. And so you have to give up either more time or more labor or more products or more services or more assets in order to get your hands on the same amount of dollars that you owe. The dollars become much more valuable. This is very painful in the short term, but after a reset, you get really good growth as long as nobody stops it unnecessarily along the way. But because it is so painful and you do get so many defaults and people who just simply cannot pay the debt along the way, so many bankruptcies, so much unemployment, we are almost certain to see policies that would prevent something like this from taking place, which means we are probably not going to see a balanced budget. The next option is actually default, and we already see some signs of this, that for at least some of the debt, they are laying the groundwork to not have to pay it back. Like Trump's saying recently that the US might have less debt than people think because some of it is fraudulent. Now, to be completely honest, the federal government defaulting on its debt and just saying we're not going to pay it back is really the most honest way out of this whole thing, because really they cannot pay their way out. We look at austerity and we see for them to be able to run a surplus, they would basically just suck all of the money out of the financial system, and it would be near impossible for them to pay back all the debt. We also know that if they inflate their way out of it, they're still defaulting because they're paying back dollars that are worth less than the dollars that they borrowed. So really, no matter which way you look at it, they're going to default. So just doing that proactively is probably actually the most honest way out. In this case, it would be lenders who pay the price. But to be honest, most of the lenders are large financial institutions that have a monopoly on the legal ability to loan money into existence. So they've been profiting off of this system the whole entire way. Wouldn't be the worst thing in the world if they're the ones that have to pay the way out. Now, obviously, the big negative downside of this is that most of us have our financial net worths tied up in the financial system as well, unless you have your Bitcoin stored in your own wallets or you have physical gold. Everything else is kind of tied up inside the financial system. In other words, the financial institutions would be taken out and most Americans would be taken out along with them. But if they were to default, then it means that they would not be able to lend into infinity anymore. Once the United States government defaults, the Treasury, the US Treasury, stops operating as a foundation of the global financial system. It is not the risk-free rate anymore because the United States debt is not risk-free anymore. Now, if this sounds crazy, just consider the fact that there is precedent for this. The United States government has actually defaulted in the past. In 1934, the US dollar was redeemable for gold. In other words, it was debt and the United States government owed gold back. And what FDR did was outlaw gold ownership for American citizens, and then he confiscated all that gold from the banks and from the Federal Reserve. In its place, he gave them dollars that were no longer redeemable for gold. In other words, the promise to repay gold was defaulted on. And then the United States government did this again in 1971. The rest of the world still had dollars that were redeemable for gold in the United States. And in 1971, they defaulted on this promise yet again and said, we are not going to pay you back the gold that we owe you, but you can keep your paper. And so it is not unheard of and it is not unprecedented because in the last century, it has happened 2 times where the US government has defaulted on its debt. Obviously, interest rates on government debt would skyrocket if there was anybody left who wanted to lend to the US government now given the chance of default, which means that the US government wouldn't be able to continue borrowing into infinity from that point because the cost of borrowing would be so high. However, given the fact that this would be a proactive choice because of all the legal abilities that they have in order to pay back their debt and get their hands on new dollars to pay back the debt, there's almost a 0 chance that default happens, at least for a good percentage of the national debt. Now, the final option I hinted at in the beginning of the video, and this is productivity. We were looking at this chart where the US government deleveraged after World War II. They brought their debt to GDP ratio from 120% down to 30%. A large part of that was due to the explosion in productive output. In other words, the real goods and services and wealth in the economy absolutely exploded over that time frame. Now, a lot of this was due to new people entering the workforce, but we could see a similar effect going forward into the future. Deregulation across the economy would simply mean that the government is a smaller tumor on the economy, meaning it's not putting unnecessary roadblocks in front of innovation and business activity. A very simple example of this is the EPA, which includes so many costs and regulations and roadblocks and hurdles for car companies that you take a car that should be able to sell for $10,000, and by the time you're able to meet all of the obligations from the government to be able to sell that here, now you have to sell it for $35,000 just to break even. A good rule of thumb is anytime you see a business doing something that seems completely illogical, especially if it looks like they're giving up a bunch of money in sales, it's probably because the government is forcing them to do so. Car companies would be more than happy to manufacture cars that they could sell for $11,000 or $12,000 at a profit. And you and I, people, would be more than happy to buy those cars. But it is outright illegal to do so. And it's not like they can't. These cars are selling overseas in different markets. But in the United States, they simply can't due to laws. Deregulation like this, but applied to the entire economy, would be like lifting a really heavy boot off the neck of the entire economy. Productivity would absolutely explode. Things like energy, deregulating nuclear energy production, artificial intelligence, robotics. All of these things have the potential to drastically increase the goods and services and the wealth that people have access to and lower the cost of accessing that wealth. Now, at the end of the day, when we're talking about the United States government using a growth in productivity in order to deleverage itself, that does mean that the US government is confiscating more of that wealth. And they are really, really happy with doing this because they're able to do it in a way where people don't actually feel the pain. Think of a personal situation where you're making $50,000 per year and you have debt that's worth $50,000. That debt payment is probably pretty painful for you considering your monthly income. But if you are able to increase your income to, let's say, $500,000 a year, suddenly paying off that debt doesn't feel so painful. Yes, you are still much worse off than you would be if you didn't have that debt in the first place, but the increase in income offsets that pain. And the US government would almost certainly use an increase in productivity and productive output, the growth of wealth, the growth of the economy, tax more of it in order to deregulate itself, and people would, for the most part, be fine with it because they'd still be better off than they were before. Putting this all together, this means that we are likely to see a mixture of these four solutions combined over the coming years and decades. Over the next 4 years specifically, we do have the groundwork being laid for a large growth in productivity, especially if we do get the follow through on a lot of deregulation, especially underneath the executive branch. That's where most of the overbearing, tumor-like parasitic overregulation has happened over the past few decades. So cutting down on that will lay the groundwork for a large explosion in growth. In terms of defaulting, we're likely to see very little of that, if any, and especially if there is any fraudulent debt out there that the United States government defaults on, it's not like there would be any real person or entity on the other side of that debt, which means it won't really have any net effect other than lowering the government's cost. Austerity is something that many people expect the current administration to implement, but given the magnitude of the problem and the small size of the solutions being implemented right now, the small cuts in spending, and the fact that a lot of it is getting overturned by judges, at least right now, it does not seem like austerity is a horse that you should be betting on. And then finally, printing, if we look at something like deregulation, yield curve control, or quantitative easing, it seems like that's going to be the big one that will come into play within the next year or two, especially if they compare it with an increase in productivity, which means the government deleveraging from here to get down from 120% on its way back down towards maybe 40 or 30% debt to GDP will probably look very similar that it did during that time frame from the 40s to the 80s. As always, thank you so much for watching. Have a great day.